Today I'll be looking at why your 401k explodes after you save $100,000. Now, one of the most misunderstood aspects of financial planning is the tipping point on where your 401k starts to grow exponentially. And most people quit saving right before they hit this critical number. As the owner of TaxElm, a tax technology company, I've seen this pattern repeat. Those who push past the specific savings threshold see their 401ks grow dramatically faster than those who don't. It's as simple as that. And that's exactly why we're making this video today, to show you the exact amount you need to save before your 401k hits this explosive growth phase. I'll break down the numbers, explain why this threshold matters so much, and show you how to reach it as quickly as possible. Let's get it right into it. So the first thing or concept on how this happens and why things grow exponentially is this idea of compounding interest or compounding effect. And many people have heard of this, but I want to kind of illustrate this in a powerful way. The compounding effect, this basic concept that money grows not just on the amount of money that you put in, but also it grows on the accumulated interest or returns of the money invested. So if you put $1,000 into an account, and it is growing by 10% annually as a quick example, you don't just get $100 year one, year $100 year two, $100 year three, $100 year four. You don't get just 10% interest on the amount that you put into it. You also get it on the growth. So as an example, you put $1,000 into an account with an annual compounding interest rate of 10%, just for easy numbers. After the first year, you're going to get $100 in interest on that. 1,000 times 10% is $100. But here's the key thing and how this compounding effect works. By the second year, instead of growing by just another $100, it's going to grow by $110 because that $100 of interest that you got in year one gets added to your principal balance, and now you're getting interest on that full amount. Both your principal, the amount you put in, and the earnings that you've had on it, and then you get your 10% on that. And so that's how this compounding effect, think of it like a snowball running down the hill. It starts as just a snowball, but you can take a snowball the size of a baseball and turn it into something pretty massive just by continuing to collect and add on top of what's already been there. And when we talk about compounding interest, I like to talk about this rule of 72 concept because it helps people put things into perspective. So many people are so worried about, okay, I need to get to my $100,000 and I need to get there tomorrow. Well, it's going to take some time. There's some potential to get to places quickly, but I think the rule of 72 helps not only you, but also every other small business owner understand the power of just continuing this process. So the rule of 72 that basically says the amount of time it takes money to double is 72. So divide 72 by the interest rate, and that's how you can determine how long it's going to take your money to double. So let's say your interest rate is 5%. That would take 14.4 years for that money to double. If your interest rate was 10%, it would take 7.2 years, 20%, 3.6 years, 30%, 2.4 years. And so your interest rate matters so much on your earnings and how quick this money doubles. But again, the rule of 72, you divide 72 by the interest rate on whatever investment product that you're in, and that will tell you how long it will take for your money to double. So if you've got money in an account that's earning 10% interest, it's going to take 7.2 years for that money to double. So if you put $100,000 in now, in 7.2 years, it's going to be $200,000, and so on and so on. Again, think of that compounding effect. So starting early when we talk about retirement plans just helps you allow this compound interest to work even longer, putting more years on it. If you're close to retirement, there's still reasons to be funding these things. We want to still do that, but there's less opportunity for that money to double. You're going to have less doubles in the remaining of your retirement account because you're at retirement age. If you're doing this at 20 years old, you're going to have a lot of doubles in there before you get to retirement, again, depending on where your interest rate is. And so when we talk about this and this getting to your 401k account to $100,000, why is it so important? The key thing is let's start this early because there's so much potential for it. When you're contributing in your 20s or 30s, that can mean hundreds of thousands of dollars more simply because of this compounding effect and simply because of this idea of the rule of 72. So let's go look at an example. If you put $10,000 in an account at a 10% return, and let's say you put zero more money in it, just $10,000 one time into account, earning a 10% return. After 10 years, that's going to be worth $26,000. After 20 years, that's going to be worth $67,000. After 30 years, that's going to be worth $175,000. So think of the power behind that one $10,000 investment today, where it could be 30 years from now. Now, what if you did that $10,000 year after year after year, or even more? That's the power of the compounding effect. That's the power of growing in the rule of 72 in your retirement account. Now, what we're talking about today is the 401k. And I just want to mention that that's not the only way you can build wealth as a business owner. There are hundreds of tax strategies out there anyone can use with very little effort. So if you want a completely free guide that breaks down the 70 different tax strategies and deductions you can use in your business, click the link in the description below. The next concept or idea I want to talk about when we talk about the power of once your account hits $100,000 and why it grows so much is this concept of self-funding a retirement account. And basically when you self-fund a retirement account, it means that you decide how you want to invest it in. And that allows you to invest in things that maybe you didn't even know were possible with a retirement account. And so I'll give you some examples. If you just open up a traditional IRA or retirement account, 401k, traditionally you're just going to be jumping into all these different types of mutual funds and stock market, and all these different stock market options. But if you're a business owner and you have a solo 401k and you say, no, I want to control where my money's being invested in. I don't want to go in the stock market. I want to go into other things. You can self-fund your solo 401k. You can self-fund your retirement account. And what does that mean? You get to invest in things that you know. You can invest in things that you like to invest in, and that also allows you to have potential much larger gains than otherwise possible. So you might be into real estate and say, I love real estate. I love investing in real estate. I'm putting a lot of money towards retirement. I don't have much cash to invest in real estate myself now, but what if we invested in real estate in your retirement account? And we're not just talking about some real estate fund, but what if you bought an apartment complex via your retirement account? Think of the power behind that and having that money grow within that retirement account and having that money being able to do the 72, to do the compounding effect directly in your retirement account. You know, if you might get 10% in the stock market, what if you're getting 20, 30, 40, 50%? In other investments that you are really good at. Other people we've seen this do with crypto. They really love the idea of crypto and they want to invest more into it. They want to put more money into it. They can use a self-funded retirement account to invest in the crypto the way they want to. Now, why does this matter? Why does hitting $100,000 matter so much for self-funding? And it's just the bulk of transactions you can do. Let's say you want to buy an apartment complex. If you have $5,000 in your self-funded 401k, there's not much you can do with that apartment complex. But if you have $100,000, now we have a lot more juice to squeeze. Maybe we're getting a loan to help fund that, but we at least have a good chunk of the funds in there. And so that's the growth that can happen once we hit $100,000. That's why these things explode, because we're able to do so much more flexibility. We're able to explore so many different opportunities within that investment. This goes on to reason number 3 that kind of goes along with this idea of self-funding. But if you have that much income and you're starting to create more income and you're growing a net worth, you can potentially qualify as an accredited investor. And in order to be what the IRS or the government considers an accredited investor, you have to have annual income if you're married of $300,000 for the past 2 years, or you have to have a net worth exceeding $1 million. And that would include your retirement account. So if you have annual income of $300,000 or more, or you have a net worth exceeding $1 million, you can be qualified as accredited investor. And so what does that mean? Like, why would I even want to be an accredited investor? And the reason is that it opens the door for alternative investments that typically aren't available to non-accredited investors. And I really get frustrated with this because I look at opportunities that come across business owners that we're talking with, and there are so many good investment opportunities that come across that have great returns and a great track record. But in order to invest in it, you got to be an accredited investor. And so who could really utilize a lot of these investments? Non-accredited investor. It could really help their money grow, but because of certain regulations, certain disclosures, and certain risks involved with some of these alternative investments, they require you to be an accredited investor. And the big thing about this is that once your income grows and once you're hitting that $100,000 in your retirement account, you're likely in income that oftentimes is in this realm. It opens up the door to invest in alternative investments. It opens up the door to investments that could potentially have much, much larger growth and earnings on them than, say, the stock market. It might bring some risk, and obviously you're going to evaluate that just like you would otherwise, but it opens up that door, and that's where we see massive growth. If you look at Peter Thiel from PayPal, he has a Roth account worth, I don't know the exact number, but I've heard these talk about online, worth over $1 billion. How did that happen? Because he invested in businesses. He invested in things in his retirement account, in a Roth account, that allowed it to grow exponentially. Now, could he have invested with a business with $5,000 in his retirement account? Maybe, but he'd be a pretty small investor, and that $5,000 probably wouldn't have made as big as an impact. But once you hit that $100,000, think of the amount, that chunk of change, that chunk of money in that retirement account can make such a bigger impact and can compound so much quicker, and the rule of 72 can be that much more explosive. So that's the true power around these different aspects. Now remember, although what we're focused on today is 401ks, there are hundreds of tax strategies out there that anyone can use with very little effort. So the important piece when we're talking with business owners about this entire aspect is understanding what's available to you when it comes to tax strategies and balancing them. 401k is very important, but this is just one part of that balancing act of tax strategies when it comes to being a business owner. So if you want extra help with your business deductions and all those other things we talk about, click the link in the description. Now let's talk about reason number 4. How do we get there? So you're saying, Mike, this sounds great. I want to, see this compounding effect and really see that money grow and double into very large amounts. And, I want to self-fund my 401k and have a good nest egg of $100,000 or more sitting in there ready to self-fund. And I want to be an accredited investor and have that nest egg and being able to get into alternative investments and all those different things. But how do I get there? Well, luckily with the 401k this is a vehicle that you can contribute a decent amount of money to. Remember, the contribution limits for a 401k as an employee in 2024 is $23,000. This creates massive long-term wealth potential by contributing the max. Now, if you're a business owner, you also can do an employer match. If you're a business owner, you have a solar 401k, let's say you're taking a $100,000 salary, you can put $23,000 in as an employee, and you can also put 25% of your salary in. If you're taking a $100,000 salary, that's $25,000. 25 and 23, that's $48,000 you can put away in 1 year potentially into your solo 401k. It only takes 2 years to get to $100,000. That's without the growth concept part of that. So the 401k is a great tool that anyone can get to this point. Anyone can get to this $100,000 point relatively quickly. If we're talking about an IRA or maybe a Roth IRA, now we're talking about only $7,000, $8,000 per year that we can put away. That's going to take a lot longer for that amount to get to that $100,000. We just start to see this snowball effect roll down the hill. So that's the power around a 401k, the ability to do that. The other piece is, we talk about this from a business owner aspect, but let's also talk about it if you're just an employee or a W-2 employee. You also have employer matching, and we always recommend taking advantage of employer matching. That's free money that doubles your contributions. So if your employer is going to match you, that's free money that could double the amount of contributions you make. Also remember that if you're over 50, you can add an additional $7,500 into your retirement account. So instead of that $23,000 as an employee, you can do $30,500 as an employee. Again, how quickly can we get to that $100,000? That part where we just see that snowball start to work itself down that hill and grow momentum. That's not that far away from you there. Now, reason number 5, again, how do we get there? And some of this concept is this concept of tax deferred or tax-free growth along with tax-free withdrawals. So we're talking about a Roth account. And I get a lot of people that say, Mike, I want to do a Roth account. I want to put money in there. Or people that say, I want to put money into an investment that I want access to. And so they might put money into a brokerage account. Now, what's the problem with that brokerage account? That brokerage account, and again, no problem with it, but I'm just telling you the difference between a brokerage account and a 401k. With a brokerage account, we put $100,000 into a brokerage account as an example. Well, any interest, any income, any earnings that $100,000 is making on that brokerage account, taxable to me. So even if I leave it in there to continue to roll over, continue to grow, continue to do those things, but there's dividends, there's interest, there's different earnings from it, I'm paying tax on that along the way, which that tax is reducing the amount that we can really compound in there. We're in a retirement account, whether we're Roth or traditional, that money grows tax deferred. So we have all those earnings going on in that account. It's growing tax deferred until retirement, especially if we're in a traditional account. In retirement, we can pull it out and that's where we're paying taxes on it, but we're not paying taxes on those earnings, on that growth as it's happening. We pay taxes on the exit. And so think of the amount of power behind that. If we just look at that rule of 72, that rule of compounding interest, if we don't have to take money out to pay for taxes, think of how much more compounding that can happen there. Now, where you really put the beauty in with a 401k is when you can get Roth contributions in there. Because now, sure, you didn't get a tax deduction when you put the money in there, I get that. But now, all that growth inside, tax-free. And when you go to withdraw those funds, tax-free withdrawals if it's a Roth account. So that can be the power behind it. I want to kind of recap what we've talked about today. The reason number one that just money starts to grow so quick once you hit that $100,000 is the compounding effect. And remember, we talked about the rule of 72. The reason number two is that you have the ability, once you get a good nest egg into your retirement account, you have the ability to self-fund. Now, you can self-fund at smaller amounts, but it's not going to be as powerful. You're not going to be able to get into the exact higher vehicles that you want to. And self-funding is this opportunity to invest in what you know best, and invest in things that maybe produce much better results than, say, the stock market or something else that you're forced into. And reason number three that money grows, especially once you hit high income limits, is this idea of an accredited investor. It opens up the door to alternative investments. And oftentimes, not only do you have income limitations to meet an accredited investor that you have to meet, but oftentimes there's minimum purchase amounts. If you want to invest in an accredited in a vehicle that has a requirement of an accredited investor, there's often minimums that you have to hit. And so that minimum typically is around $100,000. In a lot of investments, that's the minimum, that's the starting point. And so that opens up the door to invest in those types of vehicles. Now, the question that comes up is, okay, great, I want to get to $100,000. I'm at zero. How do I get there? Well, if we're using 401k as a vehicle, there is large annual contribution limits. In 2024, that contribution limit is $23,000. That, if we're maxing that out, that allows us to get there quickly. Now, we'll say this, if you feel discouraged about that, don't. If you can't do $23,000, don't do all the 23, but do something. Because remember when we looked at that compounding effect, we looked at that rule of 72. If your amount you can put away now is $1,000, do it. Do something. Start to put money towards this, because it will just continue to grow. And the earlier you do it, the more times that money is going to double, the more money that's going to be in there, and the more benefit that you're going to get from that. And then reason number five, how do I get there? Well, it's this idea of money within a retirement account grows tax deferred or tax free if it's a Roth account, in that it can be very beneficial, because if we put it into a non-retirement account, we're paying taxes on that growth as it's going along. So now you know why your 401k explodes after you save $100,000. You can develop a stronger financial plan. However, here's the thing. This is only a quick 10-minute video on YouTube. I can't sit down with you and talk one-on-one and actually learn your situation and help you with what you need here in this video. Now, over my countless years in helping people optimize their tax plans, I've seen firsthand how everyone's financial situation is different. You can't take advice from one person's situation and automatically apply it to your own. Since this video is generalized advice, I want to give you an opportunity here to invest in not only your 401k, but also yourself. I want to offer you an opportunity to get help with your business deductions. So if that sounds like something that you want help with, click the first link in this description. I will see you on the next one.